The trade closes red. Your stomach drops. And instantly your mind says, I messed up. But what if I told you that thought right there is the reason most accounts never survive? Because there's a moment every trader hits, usually quietly, usually alone, where they confuse pain with failure. A single red candle feels like proof that they don't know what they're doing. And from that moment, everything changes. Position sizing gets emotional. Rules get bent. One loss turns into three. Three turns into revenge. And suddenly, the account isn't bleeding because of the market, it's bleeding because of the story you're telling yourself. Here's the uncomfortable truth most trading content skips. Not every red trade is a losing trade. And not every drawdown means you're doing something wrong. Imagine two traders taking the exact same setup. Same entry. Same stop. Same risk. The trade loses. One trader closes the laptop, slightly annoyed, but calm. The other feels a spike of panic, like something just snapped. Same outcome on the chart. Completely different impact on their future. Why? Because one understands the difference between a losing trade and a drawdown, and the other doesn't. A losing trade is just a cost. A drawdown is a phase. But when you treat a drawdown like personal failure, that's when accounts start dying quietly. Most blown accounts don't explode in one dramatic trade. They erode. Slowly. One emotional decision layered on top of another. The trader isn't reckless, they're confused. Confused about what's normal. Confused about what's dangerous. Confused about when to stop and when to stay the course. This confusion is subtle. It doesn't feel like gambling. It feels like urgency. Like you need to fix something. Like the market is testing you personally. It isn't. And once you truly understand the difference between a drawdown and a losing trade, not intellectually, but emotionally, your entire relationship with trading changes. Risk feels quieter. Losses feel contained. And most importantly, you stop trying to win back what was never actually lost. This distinction doesn't make you more aggressive. It makes you survive long enough to become consistent. And that's what saves accounts. 1. The first red trade. The first red trade never feels dangerous. It feels small. Almost harmless. You tell yourself it's part of the game. You've heard that phrase 1,000 times, losses are normal. So you nod, close the position, and move on. But something subtle happens in the background. You don't notice it at first. There's no panic. No dramatic reaction. Just a quiet shift in attention. You start replaying the entry in your head. What if I waited 5 more minutes? What if I sized down? What if I skipped it altogether? None of these thoughts feel emotional, they feel logical. Responsible, even. This is where most traders think discipline begins. It doesn't. Because discipline isn't tested when you're calm and confident. It's tested right after your first loss, when your brain starts scanning for meaning. Humans hate randomness. We crave explanations. So when a trade loses, the mind immediately tries to turn it into a lesson, whether one exists or not. And here's the trap. Not every losing trade has a lesson. Some trades lose simply because probability played out. But the brain doesn't like that answer. So it invents one. You start adjusting rules that weren't broken. You hesitate on the next valid setup. Or worse, you take it smaller, just to be safe. Now imagine this happens again. Another clean setup. Another red result. At this point, the chart hasn't changed, but you have. Your focus is no longer on execution. It's on outcome. You're not asking, did I follow my plan? You're asking, how do I stop this from happening again? That question sounds smart. It feels mature. But it quietly shifts your role from executor to fixer. And traders who try to fix normal losses always create real damage. This is how a losing trade starts morphing into something heavier. Something that follows you from trade to trade. You start labeling the account instead of the setup. I'm down today. I'm not seeing the market clearly. I need a win. Notice how fast the language changes. You're no longer trading probabilities. You're trading your emotional balance. And this is the moment most traders don't recognize. The moment a simple losing trade stops being just a line on the chart and starts becoming a narrative. A story about confidence, skill, and self-trust. The market hasn't done anything unusual yet. But internally, the ground has already shifted. And if you don't understand what that shift really is, if you don't know the difference between a loss that belongs to the system and pain that belongs to you, then the next trades won't just test your strategy. They'll test your identity as a trader. 2. When losses start to feel personal. The third losing trade is where things change. Not because it hurts more, but because it feels familiar. Your brain stops treating it as a single event and starts connecting dots. Red trade to red trade to red trade. A pattern forms, even if the data is too small to justify one. And once the mind sees a pattern, it demands a response. This is where traders start asking the wrong question. Not, is my system failing? But, what's wrong with me? The chart becomes a mirror. Every loss feels like feedback on your intelligence, your discipline, your worth as a trader. You replay old mistakes that have nothing to do with the current setup. A trade from weeks ago sneaks back into your memory, as if it somehow explains what just happened. This is how drawdowns become emotional before they ever become financial. Nothing in your rules has changed. Risk is still controlled. The system is still intact. But your relationship with uncertainty is breaking down. You start monitoring the P&L more than the structure. You feel a slight relief when price moves in your favor, not because it confirms your edge, but because it temporarily quiets the noise in your head. That relief doesn't last. Because now every trade carries pressure. Not market pressure, psychological pressure. You're no longer trading to execute. You're trading to feel okay again. And the market is very good at punishing that motivation. You hesitate on valid entries because you don't want another loss. You enter late because you need confirmation. You move stops because being wrong feels heavier than following rules. Each decision feels small, justified, reasonable. But stacked together, they create something dangerous. You're no longer experiencing a drawdown in the system. You're creating a drawdown in behavior. This is the difference almost no one talks about. A system drawdown is expected, planned for, boring, even. A behavioral drawdown is chaotic, invisible, and it compounds. This is why two traders can go through the same losing streak and walk away with completely different results. One sees it as a phase. The other internalizes it as proof. Proof that they should trade less. Proof that they should trade more. Proof that they should change something, anything, just to escape the feeling. And that's when the real risk enters the room. Not the risk of another losing trade, but the risk of abandoning structure in the middle of uncertainty. Because once losses feel personal, logic stops being the driver. Emotion doesn't show up as panic, it shows up as urgency. And urgency is what turns normal drawdowns into account-threatening ones. 3. The silent shift. There's a point in every drawdown where nothing looks wrong, but everything feels off. You're still following your rules. Still showing up. Still taking trades that, on paper, make sense. If someone reviewed your journal, they'd probably say you're being disciplined. But inside, you know something has changed. You start watching price more closely than usual. Every tick feels louder. You flinch at pullbacks that never bothered you before. When a trade goes a few points in profit, you feel a rush of relief, not satisfaction relief. And when it goes against you, even slightly, your chest tightens. This is the silent shift most traders miss. Your system hasn't changed. Your risk hasn't changed. Your identity has. You're no longer acting from confidence in process. You're acting from a need for reassurance. And that need quietly rewires decision-making. You take profits earlier than planned because green is green. You justify it as protecting capital, but really you're protecting your emotions. You widen stops, just a little, because getting stopped out feels unbearable right now. You skip trades that meet every rule because deep down, you don't trust yourself to handle another loss. None of this feels reckless. It feels careful. That's what makes it dangerous. This is how traders drift away from their edge without ever consciously deciding to. No big mistake. No dramatic blow-up. Just small adjustments made under emotional pressure. Adjustments that slowly disconnect results from probability. And when probability is broken, consistency disappears. Here's the part that stings. At this stage, many traders think they're being mature. They say things like, "I'm just protecting my account," or "I'm adapting to market conditions." But adaptation without data isn't adaptation, it's fear wearing a rational mask. The market hasn't demanded a change. Your emotions have. This is where the difference between a drawdown and a losing trade becomes critical. A losing trade tests your strategy. A drawdown tests your ability to stay the same when your nervous system wants change. Most traders fail here, not because they lack skill, but because they don't recognize what they're actually fighting. They think the problem is the setup, or the timing, or the session. But the real battle is internal. Staying neutral while outcomes stack against you. Because the moment you start trading to avoid pain instead of executing probability, you're no longer inside the system. You're improvising. And improvisation under pressure is how edge slowly leaks away, quietly, invisibly. Until one day you look at your results and can't explain why a system that once worked, suddenly doesn't. That's the silent shift. And if you don't catch it early, it turns drawdowns into something far more costly than losses. 4. The moment discipline gets misunderstood. This is where most traders say the word discipline and mean the wrong thing. After a stretch of losses, discipline stops sounding like patience. It starts sounding like restriction. Trade less. Risk less. Be more careful. And on the surface, that sounds responsible. Mature. Professional. But here's the problem. Real discipline isn't about doing less when things feel uncomfortable. It's about doing the same thing when discomfort shows up uninvited. Most traders don't lose discipline by breaking rules. They lose it by rewriting them mid-drawdown. They reduce size not because the plan says to, but because fear needs relief. They skip valid setups because the market feels weird. They add filters that were never tested, just to feel safer. Each decision is logical in isolation. Together, they distort the system beyond recognition. And the trader feels proud. Proud that they didn't overtrade. Proud that they didn't force a setup. Proud that they're being cautious. But caution driven by emotion isn't discipline, it's avoidance. This is the dangerous middle zone where accounts slowly bleed while traders convince themselves they're improving. The losses don't look dramatic anymore. They're smaller, quieter. But so are the wins. And without realizing it, the expectancy that once made the system profitable has been diluted. Here's the uncomfortable truth. Many traders sabotage their edge not by taking bad trades, but by refusing to take good ones. Because good trades still carry the possibility of pain. And when you've been hurt recently, the mind doesn't want probability, it wants certainty. It wants control. So it trades selectively, emotionally, defensively. This is when a drawdown turns deceptive. On the surface, things look stable. Risk is lower. Activity is down. Nothing feels out of control. But underneath, confidence is eroding. Trust in the process is thinning. And the trader starts to wonder if the system ever really worked at all. That doubt is heavy. It follows you into every session. Every setup feels questionable. Every loss feels confirming. And every win feels temporary, like it could disappear at any moment. This is where many traders abandon perfectly valid systems. Not because the edge disappeared, but because the emotional cost of staying consistent became too high. They mistake emotional discomfort for a signal to change. But markets don't reward comfort. They reward consistency under discomfort. And until you understand that discipline isn't about avoiding drawdowns, it's about behaving the same inside them, you'll keep confusing emotional relief with long-term survival. That misunderstanding alone has ended more trading careers than bad strategies ever have. 5. When a drawdown isn't the problem. At some point, every trader asks the question they're not supposed to ask yet. Is my edge gone? The account is down. Confidence is thin. Nothing feels smooth anymore. And because pain demands meaning, the mind looks for a single explanation that can make everything make sense. The strategy becomes the easiest target. But here's the hard truth most traders discover too late. The drawdown usually isn't the problem. Drawdowns are not warnings. They're not signals. They're not messages from the market telling you to change direction. They're statistical events, baked into every profitable system that has ever existed. The real problem is what traders do inside them. A healthy drawdown looks boring on a chart. Controlled risk. Predictable depth. Measured recovery. But an unhealthy one tells a different story. The equity curve starts to stutter. Flat days turn into negative weeks. Not because the system stopped working, but because execution quietly drifted. This is where traders begin to blur the line between data and discomfort. They feel bad, so they assume something is wrong. They feel uncertain, so they search for certainty. They feel out of control, so they change something. But feelings are terrible analysts. Markets don't respond to how uncomfortable you are. They respond to how consistently you show up. And consistency during drawdowns is the price of long-term profitability. Here's what separates traders who survive from those who spiral. Survivors know exactly what deserves change, and what doesn't. They don't adjust size because they're scared. They don't tweak rules because the last trade hurt. They don't optimize mid-streak. Instead, they ask a quieter question. Am I still executing my plan exactly as designed? If the answer is yes, the drawdown is doing its job. If the answer is no, the drawdown is exposing weakness, not in the market, but in behavior. Most traders never make this distinction. They treat drawdowns as emergencies instead of endurance tests. And emergencies demand action. Endurance demands patience. One feels heroic. The other feels boring. But boring is what saves accounts. This is why two traders can experience the same equity dip and walk away with completely different futures. One panics and reacts. The other stays boring and survives long enough for probability to do what it always does. The irony is painful. The drawdown that scares traders into changing systems is often the same drawdown that would have led to the next expansion phase if they had stayed consistent. The market didn't fail them. They just mistook discomfort for danger. 6. The red line that changes everything. There's a line on the equity curve that most traders don't see until it's already behind them. It's not a stop-loss line. It's not a margin call. It's the line where a drawdown stops being statistical and starts becoming psychological. Up to this point, losses still feel manageable. Uncomfortable, but tolerable. You tell yourself this is normal. You remind yourself that every system has down periods. And technically, you're right. But then one day, you open the platform and feel resistance. Not fear. Resistance. You hesitate before placing the order. You double-check rules you've followed for months. You stare at the chart longer than necessary, hoping for something, anything, that makes the decision feel safer. That hesitation is the red line. Once crossed, trading stops being execution and becomes negotiation. You negotiate with your rules. With your risk. With yourself. You look for permission to avoid pain instead of clarity to act. And here's the danger. The market doesn't care that you're tired. It doesn't care that the last few weeks were hard. It doesn't slow down to give you confidence back. It simply continues offering opportunities and punishing inconsistency. This is where traders start protecting the account instead of the edge. They say things like, "I'll wait for a clearer setup," even when clarity is already defined in the plan. Or, "I'll trade smaller until I feel better," without realizing that feeling better isn't a requirement for executing probability. This is how drawdowns deepen without the system failing. Because the system is still producing signals, but the trader isn't fully participating anymore. And partial participation is worse than none. Wins don't feel like wins. They feel like relief. Losses feel heavier than before. Every outcome is emotionally charged. You start measuring success by how you feel at the end of the day, not by how well you followed the plan. That's when trading quietly turns into emotional labor. The red line isn't about money. It's about trust. Once trust in yourself erodes, every decision costs more energy. Every trade feels heavier than the last. And the exhaustion compounds faster than the losses ever could. This is why traders don't blow accounts all at once. They cross this line and slowly leak confidence, clarity, and consistency. By the time the numbers look bad, the real damage has already been done internally. Understanding this line, and recognizing when you're approaching it, is what separates traders who pause intelligently from those who spiral unconsciously. Because stepping back by choice is strength. Being pushed back by hesitation is not. And knowing the difference might be the most important skill no one teaches you. 7. Why most traders stop at the worst moment. There's a cruel timing to drawdowns that almost feels intentional. Just when doubt is at its peak. When confidence is thinnest, when hesitation has become routine, the probability curve is often closest to turning. Not guaranteed. Not obvious. But statistically, near. And this is where most traders stop. Not because they're reckless. Not because they gave up. But because continuing feels irresponsible. They look at the recent losses and tell themselves they're being smart. Protecting capital. Avoiding further damage. On the surface, it sounds like discipline. In reality, it's exhaustion disguised as wisdom. This is the moment trading becomes heavy. Opening the platform feels draining. Setups feel repetitive instead of exciting. Every signal triggers a memory of the last loss. The mind whispers, what if this is the one that makes it worse? So they pause. They sit out a day. Then a week. Then just one more session. And while they're gone, something quietly shifts. The market moves. Conditions rotate. The system does what it has always done, but they're no longer there to experience it. This is the part no one talks about. Missing trades hurts more than losing trades, but only in hindsight. At the time, stepping away feels like relief. The anxiety fades. The pressure lifts. For the first time in weeks, they feel calm. And the brain locks onto that calm as proof they made the right decision. Until they check the chart later. The move happened without them. The recovery started without them. And suddenly, the drawdown they were trying to avoid deepens, not financially, but emotionally. Because now it's mixed with regret. This is where traders rewrite history. They say the system was flawed. The market changed. The edge disappeared. Anything except the truth. They stopped right before probability had room to breathe. It's brutal because it's invisible in real time. No alarm goes off. No rule is broken. The trader simply chooses comfort over participation. And once that choice is made, coming back feels harder than staying away. Confidence doesn't reset when you pause. It calcifies. This is why so many traders feel like they're always restarting. New system. New rules. New hope. Same cycle. They weren't beaten by the market. They were worn down by uncertainty, and stepped away at the exact moment endurance mattered most. Understanding this doesn't guarantee profits. Nothing does. But it does explain why survival in trading has less to do with intelligence. And everything to do with staying engaged when the outcome isn't immediately rewarding. That's the moment most traders never make it through. 8. The difference that saves accounts. At some point, the trader who survives realizes something quiet, almost anticlimactic. The market was never trying to trick them. The losses didn't mean they were bad. The drawdown didn't mean the system was broken. And the discomfort didn't require immediate action. What nearly ended their account wasn't a losing trade. It was mislabeling a drawdown as failure. A losing trade is isolated. Finite. Clean. It begins, it ends, and it carries no meaning beyond probability doing its job. When treated correctly, it leaves no residue. You log it, accept the cost, and move on unchanged. A drawdown is different. A drawdown is a stretch of uncertainty, not just on the chart, but in the mind. It tests patience, emotional neutrality, and trust in process. It doesn't ask whether your strategy works. It asks whether you can stay consistent when the feedback loop turns cold. Most traders respond to that test by trying to escape it. They change size. They change rules. They change systems. They change themselves. And that's where accounts quietly fall apart. Because the real danger of a drawdown isn't the money lost, it's the identity shift. The moment you stop seeing yourself as an executor of probability and start seeing yourself as someone who needs to fix something, that's when losses multiply. The traders who last don't eliminate drawdowns. They don't outsmart them. They don't avoid them with better indicators or smarter entries. They simply stop assigning them meaning they don't deserve. They know when a trade is just a loss. They know when a drawdown is just math. And they know when their behavior, not the market, needs attention. That clarity changes everything. Losses stop feeling personal. Execution becomes quieter. Confidence stops depending on recent outcomes. And survival becomes possible. This is the difference no chart can show you. The difference no backtest can prove. The difference most traders only learn after it's too late. Not every red trade is a problem. Not every drawdown is a warning. But confusing the two, that's what ends accounts long before the balance ever hits zero. If this hit a little too close, that's not an accident. Because every trader who lasts has stood exactly where you are. Questioning losses, second-guessing themselves, wondering if the problem was the market, or something deeper. And the ones who survived weren't the smartest or the fastest. They were the ones who learned how to stay steady when nothing felt steady. If this series helped you see drawdowns differently, even slightly, pause for a moment and reflect. Think about the last time you changed something mid-streak. The last time you hesitated on a clean setup. The last time a single loss felt heavier than it should have. Awareness is the first edge. Now here's where I want to hear from you. Comment below. Have you ever mistaken a drawdown for failure? Or caught yourself trying to fix something that wasn't broken? Your comment isn't just engagement, it's a checkpoint. Saying it out loud helps lock the lesson in. And chances are, someone else reading it needs that reminder too. If this perspective added clarity, hit the like button. It tells the platform this kind of honest trading conversation matters, not hype, not shortcuts, just real psychology and real survival. Share this with a trader who's in a rough patch right now. Not to motivate them. Not to push them. But to remind them that discomfort doesn't mean danger, and that staying consistent is sometimes the hardest trade of all. And if you want more content like this, breaking down the mental side of trading without noise, without ego, subscribe. New videos go deeper into execution, discipline, and the things that actually separate traders who last from those who reset over and over again. Trading isn't about avoiding losses. It's about understanding them. And if you're still here, still learning, still willing to reflect, you're already doing better than most.